their toys. Women taking over, men are barely employed. All this money, it ain't just for the boys. ALPHA, making history. ALPHA, Wealth Alpha. ALPHA.
Welcome to the Wealth Alpha Podcast. Today's episode is brought to you by nobody. We believe that an unaffiliated, unsponsored opinion is an honest one. I'm your host, Kellyanne Winget. I'm an entrepreneur, author, founder, public speaker, and alternatives expert. The Wealth Alpha is all about accessibility, so for those of you who can't see me, I'm a 33-year-old lesbian white woman with brownish blonde hair and blue eyes, and my pronouns are she, her. Today's episode is all about investing in your alpha, both mentally and literally. The Wealth Alpha is a mindset that can prepare you to do the work behind creating generational wealth for yourself and your legacy. It's also the portfolio strategy that can literally grow your wealth. Today, we're going to be talking about both, starting with the literal alpha. Alpha in the investment world means your investment strategy's edge, the piece of your portfolio that makes it successful over all other investments. In most cases, the alpha is achieved with alternatives. Alternatives being everything outside of your traditional assets like stocks, bonds, and cash. Alternatives can include those asset classes, however, it must be invested through a non-traditional way, like through a hedge fund. A hedge fund is a pool of money that invests in securities, a tradable financial asset like stocks or bonds, with the goal of turning a profit. High net worth individuals typically have exposure to hedge funds because there's significant upside with this asset class if they work with strong managers. The hedge fund space is huge. There's almost 4,000 in the United States and over 15,000 worldwide. Most of them are competing in the same markets for the same products, and in my opinion, using mostly the same strategies. I say this because over 75% of managers are male, and over 65% are white. This doesn't offer a lot of space and variety as far as worldview and accessibility to a diverse pool of money. Alpha is achieved when you add uniqueness to your portfolio. There isn't a lot of uniqueness when it comes to a bunch of white finance guys who inherited a hedge fund from their father's uncle's golf buddy's dad's firm. Anyways, enough of that. Private equity is my personal favorite. PE, as it is often referred to, offers investors the ability to invest in privately owned, operating businesses. This can range from a small coffee shop to a massive gas station empire like Buc-ee's. There are around 4,200 publicly traded companies. This number goes up and down based on the companies going public, going bankrupt, or returning to a privately owned company. And there are over 33 million privately owned businesses in the United States. The variety and accessibility of the private space is massive. And as a fan of diversification, you can't get more diverse than that. When you have a large pool of businesses to choose from, you can be picky about the industry and the size of company you want to invest in. Most PE firms stick to one type of industry and dump all of their funds down that one single lane. This is great for the firm, but for the investor, they have to find 10 different companies to partner with to achieve diversification in private equity. Private equity covers a few different types of asset classes. Venture capital. Typically startup angel investments or first dollars in as a company's getting started. You can invest at the idea on a napkin stage, which has the most upside but might be the riskiest, all the way through the private buyout, acquisition or merger, or an IPO, initial public offering, or going public. Venture capital is more of a shotgun approach to private equity. Venture capital funds will typically invest a little bit in like 100 companies with the expectation that a handful of them will 100x over the next 7 to 10 years. This is very lucrative if done in the right way because you could make an angel investment into a startup, and anytime within the next 10 years you could walk away with a nice payday. The downside is that they all fail, or they require more capital than originally projected, which is what we're seeing in the banking situation right now. Startups were borrowing money at 0%, hoarding cash. Now they can't borrow, so they're bleeding money to keep operations going. Growth capital. Now this is where I play. We buy minority interest or create creative debt equity deals in mature-ish companies. These are privately owned businesses that have revenue and might be in a challenged state financially that requires an infusion of capital. Most companies in this space have exhausted their banking relationship. Either they've outgrown their bank or they can't get any more lines of credit. But they aren't ready, don't want to, or can't work with a large PE firm that has the capital to buy them out or take them public. That's where we, the growth capital partners, come in. We structure PE deals to include both debt, equity, or both at the same time to help privately owned businesses grow. We have mitigated our downside risk by working with operating companies that could scale and sell with the right capital partner. Most private equity firms bring more to the table than cash. We bring expertise to the management of the business. We will often replace, adjust, or add members to the executive team of the companies we fund. We partner with them with other portfolio companies. For example, we own a manufacturing company that can make all kinds of products, but we also own a branding and packaging company. We can combine the two to lower the manufacturing costs and increase the revenue on both sides. These investment opportunities are extremely gatekept because of the nature of the asset class. This is typically reserved for the ultra high net worth family office space because it takes a lot of capital and a lot of patience to invest in private equity. Most PE funds in this category are 5 to 10 year investments with payouts occurring only when there's an exit. Venture capital and growth capital are two of the main private equity strategies that most people are familiar with, but there's a ton of other ones. Leveraged buyouts, private debt, fund of funds. There are a lot of subcategories of private equity that allow funds to buy out private companies, taking majority interest in a business to scale, typically without any of the original ownership in place unless it's linked to the brand. Loan capital out at scale with an industry like real estate or oil and gas, and participating in a fund of funds, which allows a larger fund to participate in smaller managed funds with a specific industry, or a smaller fund to partner with a larger fund that might have a better deal flow. I also play in this space within PE through an acquisitions company focused on challenged businesses in the consumer goods space. We have every intention of pulling these assets through a public sale and seeing the biggest upside from those transactions. We control the entire deal from start to finish. Most alternatives require you to be an accredited investor. This means that you're liquid if you sold everything except for your primary residence, net worth is over $1 million, or if you make over $200,000 a year, or $300,000 if you combine you and your spouse's income, or as of 2020, you can take your Series 65 and technically be an accredited investor. The Series 65 is a financial literacy / compliance test that somehow qualifies a person to be sophisticated enough to make decisions about their own money. This was the SEC's way of trying to make alternatives more accessible. Spoiler alert, it isn't working. Now, if you're a non-accredited investor, you can invest in private equity through the stock market by owning shares in a publicly traded PE company like KKR, Blackstone, Apollo. You can invest in real estate, precious metals, and collectibles also without being accredited. These are all examples of alternative investments. Interestingly, collectibles is having a little moment right now. You have a lot of young people collecting and trading retail goods in their own marketplaces and making a shit ton of money. Nike shoes, purses, watches, toys, and games. This is all happening in the private, unregulated market. Precious metals has always been a great hedge since the beginning of time. Metals are used in everything from currency to batteries and infrastructure. You can own physical bars of gold or trade metals on the open exchange. And real estate. The generational wealth builder with no railings. Real estate is one of those asset classes that doesn't really need an intro. Everyone knows about it and at least knows it exists. If you know me, you will always hear me say real estate is boring. Real estate is boring because it's easily accessible to any investor. You can use your money and credit. You can use other people's money and credit to get started in real estate. You can buy your own house, second house, multifamily building, whether it's a duplex or a 1,000-unit apartment complex. You can buy raw land, mineral rights, office buildings, and more. Real estate is everywhere. The problem with real estate is that it's oversaturated with investors. Individual investors, professional investors, syndicated investors, private equity, REITs, and other publicly traded companies, and every single bank. The returns aren't as good, especially with rates above 5%, as people preach on the internet to be. Most real estate deals achieve between a 10 to 15% IRR, the internal rate of return, which is the return of capital plus interest over a period of time, typically 7 to 10 years. This gives you about a 1.5 to 2x return over a decade. It's okay. It translates to about a 5 to 10% annual return and is secured by a physical piece of property. It's a very conservative investment, which is great for beginners and for securing a portion of your portfolio. But remember, we're all about achieving alpha. And if you and your grandmother are all earning 5% on their real estate portfolio, you are not achieving alpha. There is alpha to be had in real estate, but it requires a lot more hands-on management and a unique investment strategy. I like to invest in infrastructure. I like to invest in the building that supports the businesses I invest in, the communities I live in, and the resources I use. There is a deeper purpose to real estate investing than ROI, and with any investment you make, which takes us into the final part of this podcast, the alpha mindset, or impact investing. Having the mindset for alpha includes not only the ability to educate yourself about new and challenging topics like money, but finding and holding purpose in this universe. Our money is the most powerful thing on this planet. It can shift entire communities into new financial statuses if leveraged and invested into the right people. Accepting that you are someone that holds that power and putting your money to work for yourself and your communities will achieve true alpha. What is impact investing? Impact investing is usually mixed up with the ESG movement, and the message is often lost between people thinking everything must be made out of rainbows and butterflies or the world ending. ESG stands for environmental, social, and governance. This means that an ESG company has one or more of these pillars that enables them to be successful beyond the financials of their business. Most of the attention is on the environmental piece, which is the least important, in my opinion, piece of this acronym. The truth is that impact investing is just a conscious, long-term investment strategy that is focused on making the world a more equitable place. Whether it's supporting the energy transition efforts, diversity in management teams, or community building businesses and development. You don't have to forfeit profit for warm fuzzies. You can do both. Doing both is alpha, and it always will be. Your alpha mindset, now that you know more than yesterday, you can take this new knowledge and go look at the world in a different way. Own your alpha and make it part of everything you do moving forward. Have a competitive edge in how you give back, how you love, how you work, how you invest, and how you grow. When you wield that kind of power, your confidence bleeds into everything you do, and people follow. That is the leadership talent needed today. Be that leader, or find that leader and amplify them by following, subscribing, sharing, and investing in them. That being said, if you find value in this content, remember that you're subscribing and sharing on your favorite social media. If you aren't already following me, I'm on Instagram, TikTok, and most importantly, LinkedIn. My handle is Kellyanne Wingett on everything, so find me and follow me. I provide a lot of insight, especially on LinkedIn, about what's going on in the financial space. So if you're interested to see what happens beyond the Wealth Alpha podcast, follow me there. Thanks for listening to the Wealth Alpha podcast.
All this money, it ain't just for the boys. We've been making dollars while they playing with their toys. Women taking over, men are barely employed. All this money, it ain't just for the boys. ALPHA, making history. ALPHA, wealth, alpha. ALPHA, cha-ching, cha-cha-ching. ALPHA, wealth, alpha.